Okay, well, here we are again today. Money Matters with Leigh-Anne Price here in Midland. I'm so excited because Tish Ashley is my regional vice president at Highlands Residential Mortgage, and I had you on my list of people to talk to when I started making my list of who do I want to spend time with. I just never knew when you were going to be here. So when you said, I'm going to pop out there, I was like, I'm going to get her time.
I love it.
So Tish has been in the mortgage industry for a million years.
That's what I heard.
And I got in roughly 03, 04. I was a mortgage broker, and I worked for Prime Source Mortgage with a dear friend of mine, Guy McKenzie. And then I left from there and I went over to work with another friend of mine whose wife is a dear friend, Josh Hopkins, and he was Countrywide Bank. And I was raising kids and doing, the mortgage thing in and out, part-time kind of. And then around into 2007, Bank of America bought, I don't have exact dates, so don't quote me, but somewhere in that time frame, Bank of America bought Countrywide. And the transition was brutal on me because they were letting processors go, and I'm not a process girl. I'm more of I know the guidelines, I know how to make it work and get creative girl. So I just kind of figured this is too much for me. This is my on-ramp to go raise my babies and open edible arrangements and all that good stuff. So in 2008, I got out right before the mortgage crisis.
Good timing.
Yeah, good timing. But I didn't know it was coming, right? So then in 2015, flash forward, I had lost my husband to suicide and had to figure out something to do to bring income in. And I really was looking for a career, and I was offered a State Farm agency, which is unheard of because I don't have a finished college degree. I didn't want to do insurance. And my dad said, why don't you be a realtor? I had friends that were realtors, and there's 1,000 of them in the town. And I didn't want to do that. But I had a knowledge of lending still, and I still had a little bit of a passion for it. So I went back and got relicensed, and boy, the changes starting in 2008.
Yes, ma'am.
So I passed my test on the first try, so proud, and I went to work for a very reputable producing branch manager, Carla McIntosh, at Supreme Lending. And I've been in ever since. So 2015, flash forward to today, and then roughly 4 years in the early 2000s. And boy, have things changed just since I've been back in.
Yes, they have.
Okay, so we talked a little bit last night about you. You got in 97?
97, yeah.
And you stayed in.
I've stayed in the whole way. It is in my blood.
How did it start?
It's interesting because it actually started with me going to work for a national home builder, Pulte Homes, in the early 90s. I went to work for them, fresh-faced, young, on-site sales. And I was there for 7 years, ended up in the training management positions.
On the sales side of the builder?
On the sales side of the builder.
Not the finance side?
Not the finance side, but my college studies had been economics and finance. So the numbers came easy, but I didn't ever want to just sit in a room and play with numbers exclusively without a human on the other side of it. So what I kept noticing at Pulte, though, which led me directly to mortgage, was we'd build a great house. It was economical. Everything worked. Our clients were really happy. But at the end of the month, there were families after families just sitting there at the title company waiting to close, and their documents weren't there. So I would walk down the hall to our in-house lender and say, the Smiths and the Jones are both sitting there waiting on closing. We've had them under contract for 6 months. There's just no reason. And the person, very kind person, but would just respond back, the manager there, you don't understand how many details there are in a mortgage. It's hard. And I started
97?
thinking, yeah.
In the early 2000s?
When it was way easier than current
when we
conditions.
were taking paper apps?
Correct. And finally one day, I went and opened a mortgage brokerage called The Funding Source. In 1997, I had a real good friend who was on the mortgage side at a big level, at the wholesale side, And he and I partnered and founded the funding source. He's like a brother to me to this day. 2 years into it, he didn't love retail. He wanted to go back to the wholesale correspondent side. So I just bought out the funding source and took it and built it into a boutique mortgage bank. And
So we have a lady local, and she's very respected. You can't be in the mortgage industry and not respect her. Her name's Suzanne Smith, and she founded and owns HMB Mortgage. I mean, she's legit.
yeah,
So this is what you did with the funding source.
correct. I did this with the funding source leading up into 2009. So we're in the middle of the Great Recession, if you will, mortgage centered.
You're funding your own loans
Funding our own loans.
with
yeah,
your own back.
I had my
bank.
own warehouse line,
Okay.
and it was actually one of the warehouse lenders that Highlands uses today.
That's
Still.
amazing. And it's a big deal to get a line of credit with a warehouse bank as an individual.
It
so
is.
this is monstrous.
No, it was wonderful. We felt very happy with our boutique lending, and we felt like we did very good lending. But what started happening that made me sell the funding source was warehouse lines were getting tight. They couldn't add capacity because the Fed, as part of the protection, they were shrinking what the banks could have out there. They did not shrink my lines, but we had customers lined up out the door. And I was starting to see the writing on the wall that I needed a bigger platform to be able to serve all the clients. And so sold it, went to work inside of a bank environment, found out within about 10 months that wasn't really for me a depository bank.
Okay.
A little more restrictive. I want to be able to really do what's strategically best for a client and have a platform where we can get innovative if it can save people money.
Yeah.
And so long and short, I ended up leaving that bank and going to a nice company out of San Antonio, SWBC, which is where I met Brian Bennett and Danny Deaton. And we built up the mortgage area for Dallas, or I built Dallas. They were building nationally at the time. We were there for 3.5 years together, and then a platform by the name of Highlands reached out to Brian and said, we would like to give you the keys to the car. We are a full mortgage bank, but we need leadership. And Brian and I talked, and the rest
And
is
what
history.
year is that?
It'll be 11 years ago this May, so 2013.
Wow.
Yeah. And
So funding source, bank, and then SWBC.
yes, and SWBC was wildly successful and a good run.
And Tim and Brian and Danny Deaton were there together?
Tim
No,
wasn't
Tim
there
wasn't
yet.
there yet. Okay.
Yeah, Tim
okay.
wasn't there yet. But Danny and Brian were the ones that came over, and it's just been a wonderful ride because with Brian and Danny's vision and leadership and how I like to really get my hands in the loans and figure out how can we help every single customer that is possible
Wants to
be
be a
helped.
dream. Yeah.
Yes, if they're going to perform on their loan and we can make it fit in the box, why in the
Yeah.
world wouldn't we want to do that?
Yeah.
And put that effort in, and we've built around that.
And they're a
into
leadership like that too.
They are absolutely very customer oriented, execution oriented. You know, we'll talk a lot about that.
Yeah.
Just the loans need to close timely. We need to do what we say we're going to do.
Yeah.
And that's taken this little company called Highlands direct to Fannie Mae, direct to Ginnie Mae, up into funding billions of dollars in loans each year.
Brokered relationships.
All kinds of product and relationships. So we truly have drank our own Kool-Aid.
Yeah. Well, I am very impressed with Highlands. I've been there since August 21st, 2023.
And it's a blessing for us.
Thank you so much. So, you know, as loan officers that produce, I mean, you can produce $7 million a year, and some people may go, is that a big number or is that a small number? It's an average number. 7 to 10, I would say, is a pretty average number for a 100% commission loan officer, right?
Sure.
But then you get your loan officers that are scaling, 15, 20, 25 million.
That's a lot of work.
It's a lot of
by the
work.
way.
And
They
then
have
you
to be
get
good.
beyond that, which is where Stacy and we're so blessed to have a great system in West Texas and relationships. We get calls 2 to 5 times a day recruitment calls.
Oh, yes.
And a lot of times, up until just recently, those calls, you can tell that they're an out of town or whatever. Recently, now it looks like a local cell phone number and you think it's a client calling to apply. So,
and you always take those
you
calls.
always take them.
Yes.
Always.
Yes.
So last year I was asked, I think it was in May or June, to have a conversation with you by someone I trusted. And I was like, no, I don't think so. And rates were starting to become a subject and on the rise. It was hot for me. The season was hot. I was closing a whole lot of loans. And the last thing I'm going to do in the middle of a hot season is rock the boat or having a conversation that makes me go, oh, I just never would entertain conversations. And I still to this day do not talk to recruiters because I'm not an opportunist. I don't believe the grass is greener on the other side. I do believe that how you tend to your grass, now I'm a believer that there's a difference in those things. So in May or June, I finally get on the phone with you. And we're chatting, and it was after a couple of requests, and I was like, fine, I'll do it, because when my leaders ask me to do something, I typically will do it. So we get on the phone, and it was just like this. I mean, from that day.
Day one.
And I was like, she's kind of a cool lady. Like, she's real nice, down to earth. I identify with that. And then, we have another phone call about things that kind of matter in our world, which has to do with underwriting. When you are a successful loan officer and you have a successful underwriting system, it's scary to leave that. And when you have products, because everyone knew me as Supreme. I've been Supreme since 2015. Supreme is the best. We're the best in the market. And I have friendships in the market that send me loans. I have competitors at other companies that can't do loans, and they send them to me because we had such a wide variety. And I am pretty hard-headed.
Well, and Leigh-Anne, it also speaks to your expertise and the trust that the community has in you, too.
Oh, well, thank you. So I was scared. I was scared of that phone call. I was scared of that conversation because the building just kept getting better and stronger. And so then we priced out a loan, and you knocked my socks off. I was like, oh my gosh, like interest rates. And at that point in time, I wasn't really competing and losing much. Even at, I think the day we talked, you were at 1.25 point lower in cost or rate, depending on scenario.
And depending on Govy or conventional, yeah.
And I'm kind of a girl that if you chase the rate, you're going to die by the rate.
That is correct.
Okay. So I could go to any lender anytime I want because they have a better rate. Well, if I do that and I get in the habit of doing that opportunity, then you may be chasing me company to company. I may move here, I may move here, and I don't want to do that, right? So I was like, this is a little, So I bring Stacy in, and I'm like, okay, you got to talk because she feels the same way I do. Don't move around. And Stacy had been there for 18 or 19 years. And so although we moved within the company to new leadership, she was still there for a long, long time. And so she got on the phone. She was like, wow, well, I think we need to go and do what they've asked us to do and meet them face to face. So flash forward to August, and I have just the craziest things going on that month, and it's just as big a month as it was. And on August 7th, we were supposed to fly out on August 8th. And that night I said, I can't come. My pipeline's blowing up. I have some very hard things. I've got to make sure these get to the closing table. And the person that was pushing me to move, to go make the move and conversation said, I've got your back. It's all a priority. Go have this conversation. I needed a paper sack. I mean, I was dying because I wasn't in control any longer. Really, truth be told, when I look back on it, I wasn't in control. So whatever, we go, we meet up. Next morning, it is first thing in the morning, all day meetings. And I remember sitting down at that table, and I was anxious because I don't do change very well. But Brian Bennett sat at the top of the table, and Scotty hadn't come in yet. Tim was at the other side, and you're there with us. And Brian, the first thing that Brian said to me and Stacy was, "We are a leadership of faith, and we are a company that our motto is, if you're not originating loans, you're supporting those who do." And and it was kind of quiet, and I was just like, what do you do with that? And I was just
You go out there and help customers.
wow.
Yeah.
So then, of course, we go through the day, and Tim Bartosh I think he's probably one of my most favorite professional humans I've ever met. And there's just
That's
a charisma.
awesome. He's going to enjoy hearing this too.
There's
'cause he
just a
cares.
charisma about him that he believes in you, and
Oh, yeah.
you believe he believes in you. You know? So we sat there that day, and Scott Brown came in, and then
Steve Peters
Steve
came
Peters came
in.
in, and then the
And then Ginger
IT
came
guy.
in,
Oh,
and
Ginger's so
Josh,
precious.
yeah.
All of them. So truly leadership at all levels, and every one of them.
And then the energy of Becky Hale.
How precious. I mean, that woman makes me in the marketing realm feel like a transformer. I can do anything. I can be anything. I can do anything. So she just recently helped me and worked very hard to help me get our Google all corrected. So we leave. We go have amazing steak and wine that night with everybody. We get on the plane the next morning, and Stacy and I are on the plane, and we're like, and it was my birthday. August
Yes, it
9th.
was.
My birthday. And I was like, and when we went, truth be told, when we were flying down there, I was 80-20. 80 staying at Supreme, 20 open to an idea. And Stacy was about the same. And when we came back on my birthday, we were 80-20. And now we were
reverse.
80, reverse. And I said, okay, what was your number one thing? And she said, leadership. And I said, that's my number one thing. And I had heard a quote that said, people don't leave companies, they leave leadership. I love Scott Everett. I love Stacy Pearson. I love Martin Bruno. All the leaders at Supreme, I love them. They have a very dear, and I feel like I could call any of them tomorrow with a major emergency, and they would do everything they could to help me. So I have a friendship there, but there was some other things going on that we needed to change or restructure, and we didn't realize how prime we were for that until you.
Aww.
So we came to Highlands because of leadership.
That's cool. When I think through from your vernacular that story and how we met, from my side, I had been hearing your name for a year or so, and I kept saying, I grew up in West Texas. I am a West Texas gal that has built a nice career, led a lot of people, helped them grow their business, and I want to know these dynamic ladies that are doing it in what was my backyard.
Yeah.
You know, take me home.
Yeah.
And so when we got on the phone that first day, it didn't even feel like it didn't feel like a new acquaintance. It just felt like I just need to get to know you deeper because we kind of come from the same space.
Yeah.
And there is something special about people in West Texas. I mean,
Yeah.
it's different.
It is
and it's hard
different.
to put your finger on it.
I
but-
tell people a lot
it's
when
different.
they're moving here, you know, you don't come to West Texas for the scenery, but when you get here, you fall in love with the people and you make a lot of money doing it.
Yep.
And you can fly and travel and go anywhere you want to see waters and mountains and oceans but you don't get people like you get in West Texas.
No.
And I love my community. The West Texas community is a very special community. So I agree with you, and I'm glad that you are a part of that.
Well, and from my perspective, it's so exciting to be taking part in helping you guys grow to that next level. Mm-hmm. You already had a very successful office going, and people are very attached to you. But it's neat to have females working together and driving this and figuring out, okay, it was really, really good. Now, how do we make it better?
Well, and that was such a big deal when we had that conversation. we had it going. We had team lead scrubbing, and we had, I call them production partners. Other people call them loan officer assistants. Then we had processors getting it all to closing table, and our closing ratio was almost 99%. We had very few fall apart. But you showed me the saying that you created on your team. This was a big deal for me. Sitting there on August 8th, and it's the calendar.
Mm-hmm.
And from August 8th to August 27th, and there were files past the 27th, but from August 8th until August 27th, those files were out of underwriting and or cleared to close.
Mm-hmm.
And I was like, what in the world life is this? And you were like, we don't sit.
Mm-mm.
They go in underwriting. And I'm like, right. That's what everyone says.
There is an extraordinarily high sense of urgency at Highlands. And if somebody is interviewing for a position, in any position, even operational compliance, anything, and we don't pick up on that sense of urgency, it's probably not going to be a good fit.
Yeah.
Because customers are anxious when they're in that line. They've fallen in love with the house. They want to get to the closing table. You've already told them it's going to be okay. I've vetted everything.
Yeah.
But they still have, butterflies in their stomach. Yes, it's important to them.
So get underwriting approval.
Get it done.
Yeah.
Just get it done.
Well, and a lady came into my office today. I don't know if you saw her. She brought me those hand crocheted roses today.
Oh, I saw her in there, but I didn't know what she was.
Yeah. So I told her all along, it's going to be okay. And she cried all along, bless her heart. And I was like, I'm telling you, I wouldn't have let you go under contract if you weren't going to be okay. And in the beginning, we were looking at a possible manual underwrite, but the file strengthened as we went along. And I'm not afraid of a manual underwrite. We had everything we needed. Well, up until 2 days before her closing, she still didn't believe it, and we were clear to close. And I was like, we're not doing anything else. You're done. We're done picking on you. You're done worrying. All you have to worry about is showing up with your driver's license and getting your keys. Cried at closing. And those are the sweetest stories to be a part of.
But Leigh-Anne, you think about it. That's the most important thing going on in almost every buyer's life at the point of being under contract. And they're trusting us with that.
Yeah. And the fact that...
So we owe it to them.
We owe it to them. And the
done.
fact that Highlands, from the day of that leadership introduction in August, I mean, we saw the tenacity and the importance in the back end stuff. And then, you move your underwriting, you move the processing, you're moving to people who don't even know you. And we're a high operating, high energy, high performing team. And we're not coming over with 2 of us like what we did before. I think at that time we came over with 8.
Yes.
And now we're coming up to 14 in a short period of time. So we're coming on as a big group, and y'all are already a moving, well-oiled machine, and here comes our freight train.
No, it's good. It was so fun.
It has been.
I still remember a conversation, I believe it was with Stacy. I think she was going straight on vacation right after y'all got here.
She was.
Or she was out of town for something. And I said, don't worry, I'll take care of these customers. And I think that first one was clear to close from day one, like 6 days later, including an appraisal.
Yes.
And I remember her surprise. It's what?
Yeah, none of us could believe it because she did. She turned in resignation and left everything on my desk to handle that part of it, and she left. And she was first one on the team to close a loan at Highlands, and it was clear to close. I think it was 6 or 7 days, and both of us were like, we better not get drunk on this because we could really fast. But it's happened
if you
multiple
have everything
times
up front.
I mean,
there's no reason.
I closed one in 9 days.
Yeah.
I mean, it just has been so beautiful. And then I've since learned, you guys painted the picture of how amazing everything was. Well, then I've learned, no, Highlands really is known for their 2-week closes.
Oh, yeah.
For whatever reason, it's a thing. And so, leadership, interest rates, and then products. Those were, we didn't have a one-time close, which allowed us to do a construction loan at Supreme. I think Supreme has one now, but this one's really special. And then there's some other cool products, which I've talked on a couple other podcasts about, like the Flex Cap, where people can leverage their equity and not go contingent on a purchase. There's just some real creative resources that we have that I love.
They're tools in the toolbox to empower our loan officers to really be able to meet the customer's needs.
Yeah.
I want to go back to the one-time close because this is a relatively new addition. I mean, a lot of places have a brokered one-time close. We invested in an in-house expert who built out our system. So in addition to one-time close, construction as part of a purchase to renovate, et cetera, even extensive construction is easy to do now because of Evan.
Yeah.
And I used to, we've all done the math now. It's been a long career so far. And
A million years.
I have always told my loan officers, and I've run good sized organizations, and I've always told them, if you're offered a 203K, refer it out to somebody that specializes in it because nobody's going to be happy with it.
Yeah.
Now with Evan, because he is involved in every step of it and it's 100% in-house, take the 203Ks all day long.
And he's so detail oriented.
Yes.
You wouldn't know he had an entire organization of loan officers needing him.
No.
And he's one guy. He has helped me
Yeah.
tremendously. He was like, you have a house that comes in under value and it needs some repairs. He's the one who pointed out you can go above a certain percentage above the 100% loan to value because of, and I was like, now that's a strategy. Oh my gosh.
But think on the big scale. So you've got FHA doing it, the 203K, and then the homestyle renovation with Fannie, and we have that directly in-house as well. So we can, if it's a better fit for FHA or conventional. But think about this. One of the challenges in the market, in speaking with your dear friend last night, it's inventory.
Oh, yeah.
People are not wanting to let go of their houses until they know they have another. Well, part of the inventory problem is that some of the inventory out there still has some outdated elements. Let's say,
Like pink walls.
I was about to say 1970s are calling and they want their gold shag back,
Yeah.
And now imagine opening up those houses to people that don't have the money to renovate them,
Yeah.
just the cash flow, but could afford the payment to get their house and take something with good bones,
Finance it in.
and make it exactly what their dream house is.
I've done several renovation and 203K loans, and they don't scare me. I actually kind of like them because I get
creative,
to see people, and they're not having to spend $200 or $300 a square foot on brand new construction, but they're getting the home that they want.
Yes,
And I tell people on 203Ks, especially in West Texas, hey, six weeks, let's plan. If we can close it sooner, by all means, we'll close it sooner. But let's plan on 6 weeks because of the consultant situation. But renovation loans, we good.
So here's a fun thing too, and Evan probably told you, but on our homestyle renovation, with us being direct to Fannie on it, the consultant is optional, and we're choosing not to require the consultant.
FHA? Or
conventional.
Yeah.
Conventional. And most lenders do require the consultant.
Yeah.
But out here, it's a huge advantage not to need it since you don't have a plethora of consultants to pull from.
Right. Yeah. Well, I am so impressed. And then I had a borrower on the one-time close. It's such a foreign thing to me. I had a buyer call me, and he was referred to me, and he said, I've had my builder denied by 2 other lenders. I don't think you're going to be able to get it
the
done.
builder for the one time.
Yeah.
Okay.
So I was like, well, why is he being denied by the other lenders? And he says, well, he's only built 4 or 6 houses or whatever the number. I was like, okay. I said, well, let me make a phone call. So I call Evan. I was like, this is what he says. And Evan says, well, it's an in-house product, so we have a little bit more leniency. Here's what I need you to get me. So he sends me a package. Builder gets me everything I need. In 2 days, the builder was approved through HRM.
Love it.
So
It was common sense.
It was, and Evan's like, if it makes sense, let's do it. That is the attitude. So it wasn't just told to us during the recruitment onboarding thing, or the courting. It wasn't just told to us, you're either supporting a loan officer or you are a loan officer. It's happening. Oh, yeah. And I love that we made this very difficult decision. And Supreme's always, I love them. I love the people, but I just love where we're at right now too. So, and I think it's going to get better. And the other thing is, I believe in leadership to teach me. And so I want to keep growing. And when you told me your last year of production 2 years ago, your number was
110 million.
By yourself.
Yeah, not by myself. The whole Highlands team made that possible. But yes, that was my production
That was
number.
your personal production.
That's my personal production. And the branch did 760 million at the same time. And I was managing, and I'm very hands-on, as you have learned.
Yeah.
The branch's pipelines. I can tell you that couldn't be done. That is not a statement about me.
Yeah.
It could not be done
without systems.
Right, and without
people.
a platform that is all rowing in the same direction to the benefit of the customer, because that's what it always comes back to.
And I get to a place with myself where plateauing is very deflating for me. I'm a numbers girl. I'm a goal setter. I want to, if I'm not growing, then I'm not learning, kind of thing. And what I've had to learn is that growth sometimes isn't in numbers. Sometimes it's in this other stuff. So the last 2 years, I've had this other stuff going, and, I topped out at like 39.8 million, I think was, and
Which is still excellent, top 1% numbers.
If you're in the lender world, these are big numbers, and I've known a few people that are in the 100 million, and I'm like, do you live? Do you have a life? Do you, and they do, and there's a few that I follow that are just dynamic, and like mortgage nerd Denise Donahue. I just love her. I love watching her. I love listening to her. So there's a way to scale to get there, but you were the first person that showed me and talked to me and said, and I mean, maybe I'll go to 110 million, but I just want to get 60 for God's sake, So
you got to go through 60 to get to 80.
Exactly.
Yes.
So when you told me that, I was like, I'm jumping on board with this, and I'm really, really, really excited about that. And the other thing that I really love is that you guys, as a leadership team, y'all don't blow down our ideas. So here we are in this right here. And when I talk to you about education and educating my market and the importance of that to me, you always have a nugget of wisdom to bring. And today we were kind of talking through this earlier, and I told you people don't understand rate compression. They don't understand the shiny rate versus the reality. And so I would love to share with my audience some of your nuggets of wisdom on the subjects.
It's funny because you and I can sit and nerd out on all the number stuff in the market and blah, blah, blah. Most people are just interested in what's my best financial move.
Yeah.
And words like market compression is something that a lot of people are not taught, but it's very much a reality that drives what's best for a customer right now. The reality of the market is that compression simply means, in real terms, that the delta between rates is compressed. The rate coupons are compressed, and there's not a higher coupon that is paying back 2 or 3 points that you could give back to the buyer.
And to break that down means the rate that the feds are passing on to us and the margin that is in between the Fed and us. There's no wiggle room. There's very little wiggle room.
No, and there's not a lot of secondary market value in loans. So if you go backwards 3 years, you could easily find a price, a rate that you could give the customer a 1 or 2% rebate back towards their closing costs at that rate.
Yes.
That is very hard to find today because of the compression. Those rates really don't exist. Part of the reason that is that Fannie Mae bonds are not going to pay, it's not going to securitize at a radically higher rate because most loans going on the books today are largely believed to be refinanced in the next 18, 24 months.
So that's what I tell my people right now is, and I mean, you kind of heard me talking to a client today. I am talking people out of buying down their rate. I'm talking them out of paying a discount
excessive points.
Because it doesn't make sense. We know we're going to go through a refi boom, and we're less than a half of a point spread from the real rate and the shiny rate. that they can go get online, and it's going to cost you X amount of dollars to do so. It doesn't. The recapture on it just does not make sense. And every time I break it down and I put it in a graph and I go, well, here's the shiny rate and here's the cost.
And we can give you that.
Yeah, it's available to you.
Mm-hmm.
And then here's the real rate, today's rate, and here's the zero cost, and here's the spread in between. And, I do the math and they're like, oh, you're right. I see it. I can afford $57 extra a month or whatever the silly number is to go from shiny to reality.
And save $7,000 at closing or whatever that number is.
Exactly. Yeah. And so that is so important to me right now. It's taking the time, and you guys are helping me put my support system in so that I do have that one-on-one with my people to be able to educate up front, and my agents too. My agents are really loving the information as well.
One of the things I love about the way that you originate, though, Leigh-Anne, is you don't have a one-size-fits-all. There's not one loan that you're going to put everybody into. You're going to look at their whole financial picture and decide, here are the 3 things that I want to talk to them about and show them to leave them better off than how I found them.
Yeah.
And it's not just how do we do this loan, but does it beget another loan in when the market gives a good opportunity? I will tell you, Fannie Mae, their economists post projections, forecasts, and it is definitely expected that interest rates will decline in the coming years. Now, nobody has a crystal ball, but these are pretty good economists, And,
and the probability keep getting higher and higher.
Right. The question is probably more a function of when. And, yes, inflation's been a little sticky. But a year from now, 2 years from now, somewhere in the next few years, they fully expect most of the loans that are on the books today to be able to be refinanced to make it more affordable.
Yeah.
So the key is for people to go ahead and, I'm a big proponent of making sure people are educated. It's better to buy now because, and it sounds self-serving, but it's not. This is just a fact that as rates go down, the price of homes
continue to
up.
rise.
And so you end up with more principal, and you might as well buy while the cost is lower and then plan to lower your cost, your monthly carry down the road.
If the average, which I've been told by a couple brokers that this average is actually pretty low for our area, if the average is 7% increase in value year over year, in your home.
Well, and Texas has certainly seen way more than that over the last, on average, over the last several years.
Then the refi, you're safe. Quit paying rent. Let's find a way. I am the lender that's not a one-size-fits-all. As a matter of fact.
But that's such a value add to your customers.
Well, I've in almost 9 years of being back, I have one client in February. Can't believe we're in April. In February, I have
me neither.
First client in all these years that I was like, really, you can go FHA, you could go conventional. You're lower in this, in closing costs, but you're a little higher on monthly payment. And I spelled out all the options. And he got confused and flustered. He never had any time to meet. And he left me and went to another lender because I gave him too many options and it confused him. And at first I was like, I worked so hard, but now, breaking it down, not all in one picture now, let them absorb, the first option. First, they want to be excited that they're approved. And then it's, well, I don't like that payment, or I don't like those closing costs. Okay. Well, then let's look at the other options. I did this yesterday with one of mine, set it up. And then I said, now there is, I gave a little nugget. We do have the 2-1 buy down. If we want to talk about, here's this. But if you want to talk about how this works, let me know. They were on it. They already knew the terminology. And so we worked through that. And the more we got into it, the more the husband geeked out. He was like, yes, give me more. Those are really fun scenarios when they take your nuggets and they build on their knowledge.
Well, yes, and it's so cool with that buy down when somebody understands that So I may literally never even have to make a
Realize.
single payment at the real rate because it's
Yes.
been temporarily bought down and subsidized.
I love the buy down.
I do too.
And, I'm on the lender advisory committee for TSHAC, which is down payment assistance. It's one of our programs in the state. I'm really excited. In May, they're going to roll out a part of their program that allows a buy down on it. Right now, they don't. So if TSHAC's rate is this, then you have a buy down, you get down payment assistance, and you can get the buy down, which is
Well, and the buy down might be used, the DPA might be used specifically to accomplish the buy down.
yes. I mean, it's just there's some
Yeah.
really cool things on the horizon in lending. I think it just gets better and better and better by the day. And so, leadership. We've talked about education. We've talked about leadership. There's so much to educate on. And, we've talked about this flashy rate situation and the reality rate. And I was talking to you earlier today, and I've talked to my team in the last couple weeks, and we've really talked about competing for loans. And we do a lot of that right now.
Mm-hmm.
What people don't realize, when I ask them to go get me a worksheet, I can compete. I almost can guarantee you that I can either match or beat them. And if I'm matching them, the competition becomes service. And I'm going to run circles around them in service.
Absolutely.
Because you can't get them on their cell phone. They don't give you a cell phone number.
Well, you're with the company with the 97 to 99 net promoter score, which doesn't happen in our industry. So
Right.
you can run circles around them.
Yeah. So I really try to show them, hey, get me a worksheet. Well, a lot of these worksheets, and this is something that people don't know, and they're so eager and anxious to buy a house or go under contract that sometimes it can feel a little salesy and high pressure, and I don't like that.
No.
I don't like that at
Not our
all.
style.
I'm a relationship girl, and so I had this one scenario, and the guy's an accountant. So he's okay. This is the one you play.
Yeah.
You do this with, and he shows me the flashy rate of the competitor, and I go, and this competitor is someone I know very well, and I've priced loans out against them, and we're always within about 1/8 of a point of each other here locally.
Yeah.
So I see the rate, and they're quoting out of the same system we're quoting out of. So I go look, and I'm like, hey, ask your buddy what's the cost of discount point for this shiny rate? Because if someone says, I want to know my buy down, well, the answer is kind of a moving target, I've learned in the competitive world.
Can be.
So I tell the client, ask what the discount points are for that rate. So he goes and asks.
Yeah, point blank.
Sure enough, it was upwards near $10,000. And then I show what my rate is, which is not even a half a point higher. And there was no cost to that rate. And he was like, well, why isn't that almost 10,000 on this worksheet? And I said, well, that's the trick that lenders play. And it's what makes us look bad when you ask for your numbers up front because you want to make your budget and you want to build your numbers, and then you go to a closing table or you get halfway through and all of a sudden the rate has a cost. That is never an all of a sudden thing. And if it's not disclosed up front, how fair is that to you? And how am I really competing if you want me to compete if I'm not showing you apples to apples? And he just was like, it just threw him for a loop, and we got him locked in, and we won the loan just because of education alone.
Well, because of the transparency and the honesty. We
Yeah.
would never put an estimate out there without fully disclosing the real costs.
I was sad for the client. It makes me sad for other people. They think they're going in, and we know rates have a cost right now a lot of times. And so that just and in the last 4 weeks, there's been another roller coaster. And so it makes me sad to think that those people are going to have their numbers changed again on them. It's never going to be a set expected thing up front when it takes an extra 30 minutes to have a phone call and a sit down or a consultation face to face. And so last week, my team meeting was around this. And I told our team, if you're given worksheets like this, go to work for that team because I don't want that. I want our people to have no surprises. You know?
No, we feel like at Highlands that if they're wearing the Highlands shirt, they've got to be upholding our ethics, our standards, a faith-based approach to how you handle yourself and conduct yourself in business.
Yeah.
You can't check your beliefs and your commitment at the door, do your work
For a
and then
paycheck.
Right.
No.
And return
Yeah.
after. You've got to walk the walk.
It's through and through, and
But your
I'm
whole team's like that.
Yeah, they are. It was nobody was offended at the comment that I made because that's how they are, and so then it
good,
just
smart people.
Yeah, and then it just opened up the doors to opportunity of education. Well, what if we are getting beat? Well, there's room to build the relationship, and there's ways to do that within guidelines, within RESPA and TRID. And
Well, and the market's the market. We're all ultimately working within a Fannie Mae market or a Ginnie Mae market. I mean, these loans are going to get securitized into those places. The price is the price. It's really about strategy also. We're back to that, it's not a one-size-fits-all business. And so when you're looking at a customer's situation, I notice you and Stacy and your team is learning that as well. Sometimes just changing the program can ultimately meet their financial goals better. Sometimes, even if they've got a good amount to put down, I notice that you will look at it and say, okay, I know you came in with 20% down, but wow, your total carry cost could be $800 less a month is the most recent one I've seen from you. If instead, let's use a little of that down payment, pay off the truck, and put a little less down on the house. We're using the same amount of money, but your monthly cash flow is so much better.
And ironically, the cost of the rate changed on that scenario too because of the private mortgage insurance. I know that doesn't make sense. It doesn't make sense.
And to be clear, the pricing got better.
Yeah, the pricing got better on
the loan itself.
Yeah, because there's that little bit of insurance up front that ensures that the loan's going to be protected. So that was really a really cool scenario, and I really love taking care of people like that. And so when we're looking at all of that and we're competing, there's a whole lot that people don't understand the difference of between us as mortgage lenders, bankers, versus that online shiny rate. Most of the time, it's so important for people to, because when I get the worksheets or the loan estimates, the very first thing I do is look up the name of the company. Most of the time, it's a broker, right? So
certainly in current market,
a mortgage lender, we're a mortgage banker, which means we're non-depository. You can't come deposit. You can't drive up and put your slot and pay your payment.
We have
right?
no tellers.
No, we have no tellers, but we fund our own loans. That's what makes us a mortgage banker. And my license is regulated through NMLS. I don't work for a bank and under a bank's licensing. Right? Which changes the game for these online shiny people because it's either a broker who's farming you out to 20 different people and probably charging an origination.
And who, interestingly, doesn't own in their own underwriting decisions, their
the
appraiser panels,
yes.
all these things that have very real impacts on the execution of the loan to get to the closing table on time.
You have no control. When it's a brokered transaction, you can't reach the underwriter usually. It's their way or the highway, period, paragraph. Then if it is a banker,
a depository banker,
we're just gonna call one of them the astronaut lender. Okay.
Yeah.
We might know who I'm talking about. Well, it's call center. Those people originating loans are at a 1-800 cubicle desk. They are not licensed. They see you have a 680 credit score, and they see that your debt-to-income ratio because of the income you've stated is a 35%, and they see that you have $30,000 in the bank. It works. Send it to underwriting. But what they don't do in that scenario is they're a call center. They don't know guidelines. They don't know that you can't use that over time because you haven't had it but 8 months. But they throw it in there. They issue a pre-approval based on what's told to them. And then it falls apart and everyone's lost money and they're frantic. And if you have I have relationships with a lot of agents. A lot of my team does too. And they're like, can you save this deal? I've only had one in the last couple of years I couldn't save that should have never gone under contract. We can get creative in so many cool ways. But when you're going online, because you don't like our local rate, the real rate, be careful of who that person is because they may not be qualifying you accurately.
It happens. It's happened so much. We literally came out with a fun little marketing program. We call it the EMT. And I don't know if we've introduced it here with your crew yet as you guys have come on. I think we have, though. You use it all the time. You just didn't know the marketing piece probably. But EMT is Emergency Mortgage Transfer. And the idea is, hey, business sources, hey, customers, if you start to feel like something may be going awry on the mortgage with a different lender, have us take a look at it. We'll take 1 day to vet it, and then we'll close it 7 days later.
Oh.
It's
we're already
operating in it. You're already operating in it. You just don't have the marketing term for it yet. But this conversation has made me think of that's a cute thing to bring to the marketplace. It reminds people that we really have the confidence that once we've looked at the loan,
we'll make it work.
Let's go, and we'll make it work fast.
West Texas, we're coming with the EMT.
That's right. That's right.
That's awesome. So with the EMT, we have that. That goes hand in hand.
You've been living it already.
Yeah, because well, like I said, Highlands is known for 10-day close, and by guideline, disclosures have to be out in 7 days. That's a guideline thing, and if there's already an appraisal, we just transfer it over, and whatever. So, there's some really cool things, and now we face as lenders, and I call it mastering my craft. I love what I do. I don't feel like I work a day of my life because I just really love it. Whether I'm working from home, whether I go over to an agent's office, whether I bring my laptop, it doesn't matter. My laptop's with me at all times. And I love it. I never feel, So now we are up against a new thing as lenders. And it's all the raved talk about the NAR lawsuit. And while that doesn't really affect us, I feel like we went through ours in 2008. And I have kind of tried to tell people we went through this in 2008 as lenders with disclosures and non-disclosures and origination fees and
as they built out in the following years, Dodd-Frank and the creation of CFPB. I mean, these were the most sweeping changes in lending.
And Regulation Z on the disclosures and those things. So, because I remember back in the day, I only needed to close 1 or 2 loans a month because I could make money on origination. I could make a little commission on whatever the spread is on the rate. Looking back, I mean, was that the right thing to do? Probably not.
Well, it was the industry norm, but...
Yeah, you go with whatever the industry does, right? So today I was talking to you also about the average loan officer. The average loan officer makes 0.76 of the loan amount. So if you have a $100,000 loan and the average loan officer, straight commission loan officer, makes 0.76, that's $760 on that loan, right? And I told you I've had many, and Stacy has too. Hey, what are y'all going to do with this NAR lawsuit? And what are you going to do with the compensation of buyer's reps? And can you finance that in? And can you? And I go back to thinking about all the things I studied to get relicensed in 2015. I think about my itemization of fees and seeing where everything goes. I think about my client that has $4,000, and in that $4,000 is his earnest money, his appraisal fee, his inspection, and I need seller concessions and I need down payment assistance to get this transaction to the closing table, right?
Yeah, just for that buyer to have enough physical cash to do it.
Just for that, right? So then I start processing as the lender that wants to make it work, that wants to get creative. I want the buyer's rep to get compensated. This has,
sure, they work very hard too.
if not harder. I have an agent I'm in the middle of a transaction with right now. She showed this client 24 homes. She has a 7-year-old son who's very active. She has a freshman in high school who is very active in his stuff. She's a fiance. I mean, like she has, and people don't shop 9 to 5 Monday through Friday.
No.
They shop during dinner time, and that's okay. We chose this career, but I want her, she deserves compensation, right?
Absolutely.
So the buyer's rep compensation has always been a negotiated thing. If you spend any time learning about all of this, it's always been negotiable. It's also always been assumed on the seller side and or built into the price of the home because the appreciating values of the home. So when I was asked about this, I've kind of dug in. I've dug in to read. I've dug in to try to learn, and I want to read this to you, my leader. Might be a little bit long, but I want people to hear what we are. There's still so many unknowns on the subject for us as lenders, right?
Right.
And I want you to speak to these different pieces. Will buyers still be able to obtain a mortgage after the settlement? Now, this goes into place in July. We believe there's going to be countersuits. We believe there's tons of moving pieces. So, as the lender's response, this is what we are getting, right? Yes, based on our interpretation of regulations, buyers should still be able to get financing from Fannie Mae, Freddie Mac, and the FHA if the listing broker compensates the buyer's broker or if the seller pays the buyer's broker directly. However, none of these agencies will allow the buyer to finance a commission into the mortgage at this time. NAR is working to get clear verification to this point.
It's interesting because there's no set commission, but we're really talking about if you want to go to market norms, we're really talking about 3% of the sales price.
Yeah.
So a $200,000 house at $6,000. And a lot of people at that price point especially are struggling to get the cash to close as is. Adding $6,000 to it would be very difficult.
And to the loan or to anything else, right?
Correct.
And another thing we talked about, if there is a buyer's rep agreement and it's a part of our transaction because it's going to end up on the final settlement statement, the CD, we have to verify those funds in addition to the funds they need for closing.
Absolutely. Now, thinking through all of those scenarios, I've talked to so many people that honestly believe that by choice, the majority of the sellers will end up continuing to compensate the buyer's agent, you know, and this is supposed. We don't know. We're not living in this world yet. Because if they don't, they will have a competitive disadvantage against the other listings.
You almost become like a FSBO or a Zillow sale because you have agents and referral partners and brokers that have buyers at their fingertips, and they can bring you to these homes, but they're not going to bring you if they're not getting compensated.
Yeah, well, and some buyers who realize they don't have the extra 3% to put into the transaction will instruct their buyer's agents, please show me only properties where the seller is compensating.
Yeah.
So you will see some market adjustments.
I agree with that.
Depending on how this ends up actually finally rolling out.
Because the good ones, I mean, there's some that are in a desperate place and just don't have it and they just want to buy a home. Then you've got others that go, I want you to get paid. I mean, I don't want you to work for free. There are the majority of people are like that.
Sure.
I mean, so then it goes on to say, I want to go to the second part of this. Can real estate commissions be financed? Financing commissions is not feasible under the current structure of the residential mortgage finance system, and there is no clear short-term legislative or regulatory fix. NAR is working to get clear confirmation on this point. First bullet point. Banks would treat such a loan as a personal loan that would have higher rates. They would limit access to those loans to borrowers with better credit profiles. Furthermore, that personal loan would add to the buyer's liabilities and make it harder to qualify for the mortgage they are seeking. So that becomes a part of their debt to income ratio.
Right.
That lowers their purchase power, right? And you've got an interest rate and possibly some of those things if it gets financed in. Second point, Fannie Mae, Freddie Mac, and FHA do not allow commissions to be added to the balance of the mortgage. Simply put, investors will only lend against the asset they can take back and sell in a foreclosure. An investor would not be able to take back and sell the commission for a service like real estate brokerage.
Right. Well,
That's not an appreciating asset or value.
No, and it can't be collateralized.
Right. And the third and last bullet point says, finally, there are significant limits to adding commissions to the mortgage rate. Several rules that make up the foundation of mortgage finance would need to be changed by the regulators and Congress. Those rules took years to develop, implement, and refine, and changing them could take years, potentially a decade or more. So that bullet point goes back to, in my opinion, simple stated, that takes us back to what happened in 2008 with the crisis, where they started changing the guidelines, they started changing the structure of the numbers, full disclosure of everything, where you could put money and where you couldn't put money. There's a reason why we went through this as mortgage lenders too, right?
Oh, yeah. Well, if you just using that comparative, if you will, the Great Recession was in full bloom in 2008, 2009. And they knew that they wanted to change the legislation. So it took Congress years to fully develop out Dodd-Frank and for the CFPB to be implemented, et cetera. And it was probably 7 years before the changes actually were fully implemented.
Yeah.
This is going to be an evolving thing, and it will evolve in a way that the market can absorb the changes.
Yeah.
And that's going to mean people will still have to be able to afford to buy homes. Realtors will still have to be able to afford to work in the industry and sell the homes.
It's going to be a little bit of a purging of the system, I think, when it comes to the profession itself. You're going to have mortgage lenders that bow out, that struggle to keep business going because of whatever. You're going to have agents that bow out. It's going to be hard. People are going to rise to the top in this situation, and I'm going to stay in my lane. I'm going to be a mortgage lender, and as things evolve, and I'm never going to tell someone to go negotiate someone else's income. I think that is so disrespectful and rude. So I'm going to stay in my lane as a lender, and as it evolves, listen to my leadership and read and study. And if I have questions, I'm going to ask before I go, this is what I think we're going to do, because nobody cares what Leigh-Anne thinks we're going to do, although I care sometimes. But, I'll take it to the grave some days. But today you said something when I was talking to you, and this kind of caught me off guard, but it didn't surprise me. And that was that in 2023, right? The average mortgage loan. So I closed 144 loans in 2023. The average loan lost in the USA a little over $1,100
across lenders. They literally, lenders lost money lending loans. So you can't fix that by doing more loans. Now, I do want to clarify, just since we're talking about lender losses, I feel like I must say Highlands is extremely financially solid. We are one of the few lenders that did not run in the red. Now, we kept it. It was a very tight line, but we stayed in the black because we have true professionals in leadership that know how to manage the books properly.
Well, and we've had loans where I show you, look at this, and you're like, that cost us $5,000 to do that.
Yeah.
Let it go. And we've let loans go. Stacy had one she just let go.
Yeah.
And it's painful when you have a passion to take the customer to the closing table and the relationship. It's painful. But at the end of the day, if that lender's closing next year, they're the ones who took the risk, not us.
Well, and to be very honest, in some cases, there are so many lenders that in the last 6 to 9 months have either shuttered their doors instantly, sold overnight without their employees knowing, without the clients. Even the clients that were actively in the pipeline did not know.
Continue to recruit loan officers like us and change names.
Even while they were in an active forced sale. And the reason these mergers, acquisitions happened and closures, and these are some big names too. People can Google that and they'll find some places that will surprise them. And the reason was because you can't in any business continue to lose money and
Eventually have it make up.
Have a solvent business. And the way that you stay solvent is you get tight, you get lean, you get mean, you get it smarter, more efficiency. And that's what has happened with us so well. But that being said, people do have to realize sometimes if it looks a little too shiny, it might be. And you might end up with problems before you get to the table.
Well, I had an agent call me right before I came to Highlands. This happened in, I think it was July. It may have been August, right before I came. She's, I don't know what is going on. We cannot get the loan funded. And I was like,
that's never a good sign. You made it to the
What?
table,
and
but it's not funded?
leadership at Supreme had said, hey, you're going to kind of start seeing this get ready. And I was like, and Midland's kind of behind the bubble. I was like, what? Did you close? We closed. Buyer and seller closed last week. We can't fund. I was like, what do you mean you can't fund? Nobody will return our call. The lender closed the doors. Before they sent the documents to title, they sent seller and buyer to close. They couldn't fund the loan and shut their doors. We picked it up and closed it in 9 days and funded it, and there was no trouble. And I'll never forget that is a reality. I lived it. I saved a loan because of it. And so who you're in business with matters.
It absolutely matters. And this is the most tumultuous of times in lending in 40 years.
Yeah.
So, I mean, it's a real risk.
Yeah. Don't look for shiny, look for relationship.
Yes, correct.
And that's me.
Trust.
I trust and relationship. I say it almost every time I can. I'm not a transaction girl.
Nope.
I'm a relationship girl. And Highlands is relational, and my team is. And
well, and you want to be their lender for life.
for life. Yeah. It's
Then
not.
you know their family story, you know their goals.
Well, and some of these, especially in West Texas, they have such creative income.
Oh, yes.
Once they realize that you understand what they're doing with their money and their income and their business, they want to come back because you understand it. They don't want to have. It's like getting on the phone with AT&T or whoever and telling your story to this rep and this rep and this rep and this rep. It can get like that in lending when it comes to creative solutions on income. So, well, thank you. Thank you for welcoming me to Highlands and just from all the way up to the top. Brian Bennett, I love his messages. When I send him an email and I say, this was good, Monday's was, I loved Monday's message. He didn't blanket respond. It was, hey, Leigh-Anne, I hope you have a great week. It was so personal, and there's a million people tugging at his, coat strings. So I just love the choice that we've made, and you're the reason.
I love being involved with y'all, really getting to know your team at a deep level and seeing where can we take this?
Yeah, let's go.
Because you and Stacy have some very real talent and skills, and the sky's the limit.
I agree.
How many people can we help in West Texas?
Yeah. Buyers, agents, brokers, and loan officers.
Correct.
I mean, come on. Let's talk about what the culture looks like.
Yeah, let's do it Texas style.
Yeah, let's go. Thank you.
All right. Thanks, Leigh-Anne.